Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Friday, September 30th, 5:19 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with the Big Show, the Friday edition of the Revere Market Insight video, where we take a look back at the prior week, take a look ahead at what's important for next week, and start the rebuilding process of the 21 over 21 leaders list. Normally, in a healthy market, we'd be talking about what stocks were replaced with, what stocks were kicked out, what stocks were replaced. We don't even have 21 stocks in this market, and that's the feedback that we look for when we gauge the overall health of the market and determine how much of our client's portfolio deserves to be in the market. You can see over here on the trend gauge, 4 down trending red arrows, meaning market leaders non-existent for the most part in a bearish / downtrend mode, and all 5 of the major moving averages below their short-term 21-day exponential moving average, their medium-term 50-day moving average, their long-term 200-day moving average. All that adds up to is very clearly the market state being a correction. And what happened today? Ugly got uglier. S&P ending the month of September down 9.3%. NASDAQ 100 down more than 10%. Rough quarter, not as bad as a prior quarter, but nice gains halfway through the quarter, all given back during the month of September and the last few weeks in August. Here are the numbers. G6, this is our growth composite, 6 growth ETFs that we track, only down 0.63%. There's been some outperformance lately in small and mid cap stocks, particularly the growth portion of them, which is certainly is something that gets our attention. And when it's time to put capital back to work, it'll give us more conviction to do it aggressively. Of course, obeying the stops that we always put in place. This is really the big caps are what got hammered today and what have been getting hammered recently. S&P 500 down 1.5%, NASDAQ 100 down 1.7%, Dow Jones Industrial Average down 1.7%, mid-caps down 0.68%, Russell 2000 down 0.61%, Global Diversified 60/40 Stock and Bond Index down 0.67%. In-house for the third straight day, GROTECTION flat as we remain all in cash. Only did 2 trades this week. One was to do an oversold entry into an index ETF. That reversed. We took tiny profits on it, which ended up, wasn't apparent at first, but ended up after the action of the last 2 days, that was certainly the right call, was to get out of the way of that as the market weakness continues. And a couple of really negative data points that I want to discuss when we get to the tail of the tape. Here's a monthly chart of the S&P 500. You can see breaking below the 30-week and 40-week moving averages. When you get below this green line, you can see going all throughout, going all the way back to 2000, below the green line is a serious issue for the markets. It's much worse even than the 200-day moving average, because we're in the teens below the 200-day moving average right now. Let's go back to the daily chart of the S&P 500. You can see 14.9% below the 200-day moving average. So this chart describes what we do at Revere. When I say we're trend followers, we look at a short-term trend, a medium-term trend, and a long-term trend. That's the green line, the red line, and the black line. And when the market is trending above it, we have no fear being fully invested in the market. When it starts to roll over, sometimes you trend for weeks, sometimes months above these short and medium term moving averages. But when they start to roll over, what happens is our stops will start to get hit, will get taken out of the market. If the correction gets more serious, the slopes of the moving averages will roll over. And this is really telling us that we're at risk for more downside. And then if you break below that black line, the 200-day moving average, all bets are off there. That's when we get extremely defensive. There are always some whipsaws as you go back and forth. But the key day here, April 21st, is when The 200-day moving average peaked, rolled over after that. We tried to get above it, and we could not get above it, and it's really been a really tough time for the market ever since then, and that's really an understatement. So we got out first on January 24th with this break below the 200-day moving average. There have been 11 times since then when we've engaged with the market, sometimes more than half engaged from a beta standpoint and a cash standpoint. And that's when we get back above the short-term moving averages, we'll do that. 11 times we got above, 11 times we got below, but this has only cost us 3%. Our first exit was 3%. Ever since then, we've only lost 3%, while the markets have lost an additional 18% since the first time we got out back here on January 24th. So when we start to trend below the 200-day moving average, this is where bear markets occur. It's just knowing your market history. Here's a list of them. All of these 13 bear markets have taken place below the 200-day moving average. And if you want to protect your capital, you get out of the way during this period. You can be involved in the market, not really even pay attention to it. You can check once a week to see if the market is above or below the 200-day moving average or the 40-week moving average if you go by a weekly close. And just consider getting out of the way. When you get below it, what you're really trying to do is to avoid these severe losses because of how difficult it is to compound capital to get back to even. The average of these last 6 major bear markets, over 30% losses. The average loss, 44.5%. To get back to even, you need 80%. Not easy to do. So, and here we are today, ugly getting uglier, making lower lows since we peaked on August 12th when we ran into the declining 200-day moving average. At the time, everybody's saying it's too obvious. We're not going to reverse here. Everybody sees the 200-day moving average, but it certainly worked as resistance, and we've had a serious drop ever since then, this being the third leg down now since we broke below the lows of June. So let's go to the NASDAQ 100. Here you can see a very similar setup, lower lows again, didn't even make it up to the 200-day moving average. Awful action on a relative as well as a price basis. The NASDAQ 100 leads rallies up and it leads the market down. Dow Jones Industrial Average also making lower lows. Terrible looking chart. Got above the 200-day moving average for a couple of days back in August before rolling over and making new lows. Mid-caps MDY, not quite lower lows. One poked below early in the week, but still sitting on this 400 level. Let's look at the growth portion of MDY. That's MDYG. You can see that hasn't made lower lows yet. MDYV, the value portion, has made lower lows. You can't automatically think that during a big market sell-off, going to value stocks will protect you. And you're going to see the same thing when we look at the small cap chart. Here's IWM hanging still above the lows from June. Here's IWO, the growth half of the Russell 2000, still above those lows. IWN, the value portion, making lower lows. So once again, in small and mid cap, it's the growth portion of those two, small and mid cap, that are holding up and outperforming. And again, as I mentioned, we're a growth shop. That's what we want to see when we start putting money back to work. So if you're interested in following a trend following approach like this, get you when the market's going up, get you out when the market is going down, shoot me an email, don@revereasset.com. You can also email Dan at revereasset.com. That's the Revere president. He's a CFA. You call the number 855-REAL-WEALTH. That's 855-732-5932. He'll answer it, get all your questions answered. Just a few simple forms to fill out if you want to become a client. And it's not much more expensive than being stuck in a useless pie chart that's going to ride your capital lower under the cloak of perceived diversification, which just, let's take a look at bonds this year. Here's BND, terrible chart, down nearly 20% along with the indexes. So let's go to the tail of the tape and see what's been updated. Indexes in the G6, that stochastic attempt, still in place for a couple of the indexes, but you can see it's flagged back down and the moving average is flagged back down. So that one good day that we had in Wednesday, hoping for further progress to the upside, we absolutely didn't get it. So right now that attempted hookup is looking dead or arrival. Put call ratio at 1.12 can absolutely go a lot higher than that. VIX only at 31.6 and is actually down today, despite the fact that the indexes were down 1.5%. We're above all moving averages on the VIX. That's a bearish sign, but we can certainly go higher with it only being at 31.6. We're kind of looking for a spike up to 40 before we would get some kind of that should coincide with some sort of a big washout that might put in a short-term bottom on the indexes. Fear and greed down to 15, unchanged. That's in the extreme fear level. Still working under the bear case, really since Powell's 8:26 speech spiked the rally attempt. Some news today. The Fed watches this PCE inflation. It came in worse than expected, and that put a cap on any advances that were hoped. A weak oversold bounce in the early day today rolled over, and we trended down for the last 4.5 hours. PMI was weak. That's perversely a good thing because we're looking for a weakening economy to dull inflation numbers. Again, the PCE numbers worse than expected. So this is our second down day. If we're counting days, S&P continues to hang in this range of -4% to -6.5% below the 21-day moving average. That's pretty darn bearish. Sometimes hoping we would go sideways here and have the moving average catch up to it, or with this being so oversold, and this is a number, the 6.5% is extreme to the downside. Is the reason why we took after this false breakdown on Tuesday, we took that entry. Sorry, it was on Monday. We took that entry, but couldn't even get up to the 8 EMA. So again, real significant weakness on the indexes, showing no ability to bounce whatsoever. Negative expectations since the 9/21 breakdown confirmed again today. With the weakness, we broke below the support levels on the NASDAQ 100 and the S&P 500. Biotech was up today, real estate was up, and gold stocks were up. Gold stocks, we're starting to dive into these. They've been showing relative strength over the last week, while the indexes have gone lower. 10 out of 11 sectors lower today. Only real estate was the one that was higher. Retail very weak as Nike's poor earnings report trickled over into sporting goods, and anybody selling sporting goods or footwear like Dick's and ASO, and oils were down also on the day. No, actually, they recovered somewhat. They were weaker during the day. They still finished down, but not weak relative to the indexes. Still focusing on shorting any bounces into resistance, but we're not getting any bounces. From a portfolio standpoint, continuing to be in all cash. Didn't make any trades today either. Bottom line, ugly gets uglier. S&P down 9.3% for the month. NASDAQ 100 down 10.7% for the month. What are the support and resistance levels? We broke below this area decisively today. Those were the lows from 617 and 923, the last two spike lows. So here was 923, that area that we were hanging around, and here is 617, but now with the break below this level, decisively below those levels. Also, this big this is a huge area in here, and it's where we're hanging out in the middle of this. Is 35.75 to 36.14. This includes 25% down year to date. That's 35.75. This is actually 35.89 is the 200-week moving average. This number is slightly higher. It's actually 35.98. So 35.89 is the 200-week moving average. 38.98 is 25% down off of the closing high. 36.14 is 25% down off of the high of the year. And this is the range that we're hanging out in. The next level down is 35.05, which is the 50% retrace of the COVID rally off the bottom. So that's the last level of support before we start calculating other extended, like the 38.5%. I'm sorry, the 61.8% retracement for COVID is quite a bit lower. Certainly hope we don't get there. We don't like the market being bearish and people losing money, especially non-Revere clients. We've been insulated very well this year, down 7.74% year to date, while the indexes are now down 24.7%, 24.8%. So we'll have a lot of dry powder to compound from a much higher asset base than people that are riding this lower when the market finally does balance. And something that has me really concerned when you look at this monthly chart and the stochastic, obviously you can see the big corrections in here. Here's the dot-com bubble bursting back in 2000 to 2002. Here is the global financial crisis. Here's COVID. Here's right now. Note the stochastic. Just now coming into oversold territory. Look at the amount of time that was spent in oversold territory going back to 2000 to 2002. If you think that we can't have a multi-year correction that we don't come out of, just take a look at the fiscal state that we're in, and we're one of the more better off countries in the world. There was a panic in Britain on its interest rates earlier this week. Is that going to be the only cockroach? No, normally there's a bunch of them hiding in the walls. So there's a real possibility of a sovereign debt crisis. These bonds moving down in sync with stocks is blowing up all kind of risk models, because the assumption is that bonds would cushion any stock drop. But all the money that was pumped into the financial system as part of COVID is ending up being more than the market can handle, more than the economy can handle. So you can see the amount of time that we spent here back in 2007 to 2009 and 2000 to 2002. We're just coming into it now for this sell-off that we're having. I don't even know what is this, the bursting of the COVID bubble, I guess we could call it. The Fed normalizing. It'll be given a name when history looks back on it. But for right now, what we know is that we're below the 200-day moving average. We're continuing to go lower. There's no signs of leadership, and we're out of the way, plain and simple. I'll update some more stats on this when the client-only video gets sent out, the quarterly client video gets sent out this weekend or early next week. But for now, let's go to what's left of the 21 over 21 list. I've got 8 stocks in here, and 3 energy stocks, 4 medical stocks, and 1 thin telecom stock that is the best looking chart out there, but it's too thin for us to trade. So here's First Solar. This has been a leader since its gap up on earnings. 1 day below the 21-day exponential moving average since its move all the way back at the end of July. This has overtaken Enphase as the preferred solar stock. It is sitting right here on the flat 21-day exponential moving average. If it breaks here, I would expect a quick break right down to the 50-day moving average. BTU is a coal stock, came back off the 200-day moving average in the last week. Just really a long base that it's forming here, a flat base going back to this new high that it made in April. The bigger the base, the higher in space. If this breaks out above 33 and energy, we've obviously got an energy problem on a global basis. Lanier has come back. LNG regained, Cheniere, not Lanier. Cheniere has regained its 21-day moving average, gapped up today, closed at the bottom of its range, but still one of the best oil and gas stocks out there. Vertex Pharma, back above the 21, relative strength at an all-time high, putting in this nice tight flat base. Neurocrine Biosciences, back above the 21, relative strength at a new high. Biotech got a big pop this week on the Biogen news. I'm not showing Biogen in here because it continues to drip lower after breaking the low of its gap up day, and I've shown historically on here every time it has these big moves up on supposed news that's been a selling event. So going to have it try to prove itself by at least making higher highs of the gap up day. That's why it's not included in there. Sarepta SRPT, another biotech stock forming a nice tight consolidation, closed right on the 21. Shockwave, this has been a leader for a while. 3 heavy days of selling here, bought right back up, gapped up this morning, closed at the bottom of the range with the market weakness, but still closed positive. That's how you isolate strength in weak markets, is the relative strength line. You can see it's very close to, if not at, an all-time high right here, while the stock hasn't quite cleared it yet. That's always something that we look for, is relative strength new high before price. It's a sign of significant strength in a stock. And finally, HLIT, Harmonic Light Wave, continues to be one of the strongest stocks, probably the strongest stock in the market. Looking at the relative strength line in the big blue buying bars, needs more daily dollar volume before we can dabble in it. So those are the 8 that I have in the 21 over 21. We've got a bunch of them in a list that I maintain that's under the 21 but still over the 50-day moving average. Be going through those stocks this weekend, categorizing them, setting alerts, getting ready for the next trip back above the 21-day, which hopefully will be part of a bullish rally, but we're not seeing any signs of that as of right now. So that's going to wrap it. As always, love to hear from you. Email don@revereasset.com. The phone is 855-REAL-WEALTH. That's 855-732-5932. Remember, folks, it's not how much you make with your money that you have in the market, it's how much of that you can keep, especially during severe bear markets. Don't let anybody tell you that you can ride them out and they always go higher. While that's true, the capital destruction that happens while you're riding them out, when you could instead employ a few simple rules to get the heck out of the way, save yourself a lot of heartache, a lot of mental, financial, and emotional energy. We think we've got it figured out here at Revere on how to do that, to get out of the way and to get back in. Our track record speaks for itself. Our growing client list and swelling asset base speaks for itself. If you've got friends or family that are having a hard time, got a bunch of new clients this week, and they're all coming from pie chart people that have told them they are to just ride it out, not worry about it. It'll come back. When you get close to retirement, you can't afford to do that. These are the clients that are coming over to Revere and are then able to sleep well at night because we've got their downside protected. So if you're interested in this approach, reach out to us. So wrapping up the week ending and the quarter ending, September 30th, this is Don Vandenbord telling it like it is. Thanks for listening and have a great weekend.